The future of U.S. stocks looks promising, driven by strong market fundamentals that could push equities higher in the coming years. But here's where it gets controversial. While the Federal Reserve has recently trimmed interest rates by 25 basis points, signaling a more accommodative stance, Chairman Powell remains cautious about inflation risks. Yet many experts, including the Chief Investment Office (CIO), believe the Fed will ultimately focus more on the weakening labor market than on what appears to be a temporary inflation spike. Powell himself has described the recent tariff-related price increases as a one-time event, and importantly, both market-based and survey-based measures of long-term inflation expectations continue to hover around the Fed's 2% target. Since the federal funds rate is still above what economists consider the neutral level, the rate neither stimulating nor restraining the economy, there's room for the Fed to cut rates further without immediately triggering runaway inflation. In fact, CIO anticipates an additional 75 basis points in rate reductions by the end of the first quarter of 2026. But that's not all supporting the bullish outlook. Corporate earnings have been robust, with nearly 80% of S&P 500 companies surpassing sales expectations in recent quarters. This broad-based earnings strength is a key driver behind the forecasted 8% growth in earnings per share for this year and a solid 7.5% growth in 2026. Healthy consumer spending and strong balance sheets, both at the corporate level and among households, add further fuel to the market's upward momentum. Plus, the current administration's push for deregulation is expected to create a more business-friendly environment, which typically bodes well for stock prices. And here's the part most people miss. Transformational technologies like artificial intelligence, AI, are not just buzzwords, they're real engines of long-term market growth. According to the latest U.S. Census Bureau survey, AI adoption is steadily increasing across over 1 million American firms, signaling that the industry is entering a new phase where AI integration accelerates rapidly. CIO highlights several factors underpinning this trend: rising global capital expenditures, ongoing breakthroughs in AI reasoning models, a growing ecosystem of AI-related businesses, and expanding opportunities to monetize AI innovations. This technological momentum could significantly boost market performance over the long haul. Putting all these pieces together, CIO projects the S&P 500 index could climb to 6,800 by June 2026. In a more optimistic or bull scenario, the index might even reach 7,500. For investors concerned about timing the market perfectly, a prudent strategy would be to gradually increase exposure, taking advantage of market pullbacks to add positions in favored sectors. But here's a question worth debating. With the Fed's cautious stance on inflation and the potential for further rate cuts, could this lead to complacency and an overheated market? Or will the strong earnings, solid consumption, and AI-driven innovation provide a sustainable foundation for growth? We'd love to hear your thoughts. Do you agree with this optimistic outlook, or do you see risks that might derail the rally? Share your views in the comments below and join the conversation.